Hello, and thank you for visiting this Tax Plan for Wealth presentation. Wealth development isn't necessarily easy, and it becomes more difficult when we allow the tax man to have more control of our funds than we should. That's why this presentation is called the Advanced Financial Freedom Plan, because taking back control of your taxes is financial freedom. For many of us, we work very hard and diligently to do what we've been taught, put some away for later. Throughout the years, we've been taught that the most effective way to save for retirement was in our 401ks. We were given the myth that we would be in a lower tax bracket in retirement than during our working years. For a few, that might be the case, but not for my clients. They also didn't tell you about the double taxation that your retirement account distribution would cause. Yes, the double taxation. They didn't tell you that the dollar distribution from your IRA could cause 85 cents of your Social Security to also be taxed, or that it can cause a Medicare surcharge called IRMA, so that the dollar distribution was actually causing a tax as if it was $2 being distributed. If we planned well, we've managed to save enough to provide throughout a retirement, and perhaps even leave some behind to make the lives of our children and grandchildren a little easier. But the truth is that many of us will lose large percentages of our wealth through a continuous erosion of income taxes. This erosion only gets worse when retirement comes. To illustrate the severity of this erosion, I teach a simple example. I encourage you to do this at home in an Excel spreadsheet to test the math. I call it a dollar doubled. I have a separate extended presentation that talks more about tax erosion in this illustration, so I'll try to be brief here. But if I start with $1 and I double it 30 times so that $1 becomes $2, which then becomes $4, which then becomes $8, etc., after $30, that amasses to over $1 billion. However, if I take the same dollar and I double it with a 28% combined federal and state income tax removed, each time a double occurs, it erodes the growth all the way down to 11 million. So the obvious question is, how can a 28% tax consume 89% of the wealth? Well, the answer is because of lost opportunity. The tax paid over those 30 doubles is only 8 million, while the lost opportunity adds up to the remaining $980 million of loss. Each time that the tax is paid, you no longer have that money available in your account working for you to grow and double. Even after only 10 doubling periods, the difference becomes significant. Instead of $1,024, you wind up with only $226. Please check my other presentation that expands on this thought, and you'll see how extensive tax erosion is to the waste of your dollar and the waste of your money. So that we start by dispelling the myth, it actually is possible to take strategic control of how much income tax you pay and the timing of those taxes, such that it can have a dramatic impact on your family's wealth, for yourself, and for multiple generations to come. Most of us worked hard developing the wealth that we have, and we know it's what we keep at the end of the day that matters most, much more than what's earned on it. At Tax Plan for Wealth, we engineer various strategies and tax efficiency models that allow you to fully take control of your income taxes with the long term in mind. As financial advisors, we understand that when it comes to managing wealth, better investment returns equals more money. But we also understand that reduced investment risk equals more safety, and that safety comes at the expense of compromised investment growth. We usually need to prioritize between the two, greater investment returns or more safety. But only when it comes to strategic tax strategies, we can achieve both. You see, reduced income taxes means more wealth without increasing risk. It's a double win, and we offer our tax planning services with a written money-back guarantee that you'll see a 10 times return on our planning fee, or your fee is fully refunded. To be clear, with our plans, outcomes do vary depending on your personal circumstance. For some, it may be possible to upfront some income taxes today to completely eliminate income taxes for the rest of your life. And for others, it's possible to be strategic enough to stop the hemorrhaging that otherwise would ultimately occur to your family's wealth. And lastly, for a few, there's absolutely nothing that can be done to strategically manage your taxes in a way that benefits your wealth. However, in all cases, if a benefit equal to 10 times the planning fee cannot be demonstrated, our planning fee is guaranteed to be fully refundable. There are so many moving parts in retirement, it takes a true expert to help you determine how to best provide a wealth benefit. The problem for most is that the advice that we have comes from fragmented sources that lack the required comprehensive perspective. The two most common sources of experts would be financial advisors and CPAs. And let me explain the challenges brought by these independent thinkers. We could look to our typical financial advisor, wealth manager, or financial planner to consult with on these matters. For those true advisors that go just beyond investing for you, the good ones are supposed to be long-term strategic thinkers with the primary goal to help you make smart money decisions over the long haul. That's the benefit this class of advisors should bring to the table. However, it's fairly rare to find one that could also claim and truly demonstrate to be a tax expert that applies that tax expertise on a long-term strategic plan. My name is David, and I started in financial services in 1980. I happen to be a registered financial consultant, a financial planner, an accredited investment fiduciary, but I'm also an enrolled agent with the IRS. As a planner for tax plans for wealth, when we do our plans, we do not use inadequate financial planning software. Rather, we use tax software that can calculate your income tax burden over multiple decades. With my nearly 40 years of experience in financial services, I'm yet to find a financial planning software in widespread use that accurately calculates taxes, or that can create a strategically blended cash flow distribution or retirement income stream created with tax mitigation in mind. While these advisors may often be well-intentioned, they typically lack the proper understanding and tools to provide a long-term tax plan. Additionally, fee-based advisors have an inherent conflict of interest. I like to explain that with our IRAs and 401ks, we don't really own everything in those accounts. We get to invest everything in our accounts, and our advisors that are fee-based get paid on the entirety of those accounts. But we rarely have the equivalent of a mortgage on those assets, a debt obligation to the IRS. And as our account grows, so does this debt obligation or mortgage. There are many occasions when prepaying a portion of that mortgage, or even the entirety of that mortgage via a Roth conversion strategy, can provide a great long-term benefit to your wealth by transferring the monies into investment accounts where the growth will never be subject to erosion from taxation again. Initially, when you pay down this mortgage, from my perspective, your net wealth stays relatively the same. But your investable assets, what your advisor gets paid on, that goes down, and that creates a conflict of interest. Some advisors are indeed suggesting Roth conversions, but they're doing so because it's the in thing to do, without a true understanding of the inner workings of all things tax. That might be akin to you walking into a doctor's office with a stomachache, and with no questioning or examination, the doctor hands you a bottle of Tums. Truly be cautious of where you get your tax advice from. The more obvious advisor when it comes to tax issues should be our tax consultants or CPAs or enrolled agents. They know the tax code, or at least they should. The challenge, however, is when I ask most folks if they have a tax strategist or if they have a tax preparer. Once I define the difference, most suggest that they have a preparer. That being someone that gathers their documents and prepares their tax filings, and then tells them how much of a check to write each year. Occasionally, these tax professionals may make suggestions about how to mitigate some of the tax burden for the current year or the year just ahead. But rarely is there any strategic modeling that would go out just beyond a year or two. Just today, I had a business owner come in with a personal tax return as a single filer prepared by a CPA of 20 plus years. It showed a business loss of $90,000 and a zero tax. I asked him why his CPA didn't tell him to convert $90,000 of his IRA to a Roth IRA, which could still be done at a zero tax, but give him future tax-free growth and future tax-free distributions. Since it was now too late to do the conversion for the year that passed, you can imagine how upset this client was over the lost opportunity. At Tax Plan for Wealth, all of our planners are experienced financial consultants with extensive training and knowledge in the U.S. tax code. most of which are IRS certified enroll agents or CPAs. So in the plans that we develop, they're done by experts in both categories of thought, but without any conflict of interest that existing advisors would bring to the table. We merely charge a planning fee for advice, which is completely refundable if we cannot bring value equal to or greater than 10 times the fee itself. I'll strongly suggest the time to do planning, tax planning that is now. The Tax Cut and Jobs Act of 2017 effectively put income taxes on sale. But unless this Tax Cut and Jobs Act of 2017 is extended, the sale will only last until 2026, when it's set to expire. Additionally, depending on politics in the U.S., who knows if it can be amended sooner or extended to a later date. So for the most part, that only leaves 6 years of planning under the current bill, assuming it stays intact. 6 years with the complexity of the interacting challenges. For some, those challenges will be taking or deferring Social Security benefits and any income tax implication thereof. For others, it could be the IRMA, or Income-Related Monthly Adjustment Amount, otherwise known as a Medicare surcharge tax. And still others, it can be the complication of your own required minimum distributions from your IRAs or RMDs, required minimum distributions from inherited IRAs, creating an unintended havoc on your tax returns. It could also be capital gains accumulated on other assets or a host of other tax complications. The goal of our strategic tax plan is to do a personalized tax plan over several decades, which is intended over a long-term time period to help you keep more of your money and maximize your estate. The best outcomes will be based on your personalized detail, and we can't always control them. Some tax strategies we create involve just one obvious scenario, while others may offer circumstances of 4 or 5 differing scenarios. This is really much more controlled by the details than our desires for a specific outcome. Following in these videos are 3 very distinct and different case studies, all of which are true clients of ours. All of the details we provide is actual client data with only the client names changed. While the client assumptions and the projected outcomes at a 20-year mark are shown, as well as the starting data, the actual work product with annual details cannot be shared until such time as we're engaged for services. In case study number 1, we have John and Linda. Over 20 years, we were able to demonstrate a reduction of their income tax bill by over 30%. For the background on this case, John is age 66, still working with a plan to retire at age 70. Linda is 61 and is recently retired. They have a combined $520,000 in IRA assets. They also have rental real estate that they're selling, and they expect to realize $175,000 from that sale after taxes. In addition to the IRA and the real estate for sale, they have another $68,000 in taxable accounts. All of the plans that we create include cash flow needs, which are typically inconsistent on an annual basis, as we, as spenders, typically never spend the same amount each and every year, even considering inflation. There might be big ticket items that change the annual budget, such as a boat, motorhome, wedding gift for a child or grandchild, automobile, or such, and we have the ability to account for those inconsistencies. There might also be cash inflows to consider, such as an inheritance or sale of real property. We factor in inflation, which can vary for each category of spending, an amount that's agreed to by the client. We also use earnings assumptions in our plan as agreed to and provided by the client. For this client, the household budget for health insurance until Linda reaches age 65 is $13,200. Effectively, it should adjust down at Medicare age of 65, but because of their chosen inflation rate for medical, on this plan it doesn't appear to. This is a modest couple with a paid-off house, believing that they need just $45,500 a year to live on, plus another $3,600 a year for travel. This couple prefers us to use a 3.25% inflation rate, and the travel for them will stop after 20 years. Other than lifestyle, healthcare, and travel for 20 years, the only other budgetary need is a new vehicle in the house. Every 5 years, they rotate out and get a new car, and they plan to trade in their car, the next one being in 2020. They expect to pay a very modest $15,000 in today's dollars over and above their trade-in value every 5 years, using that 3.25% inflation rate. Please note, all of these amounts are as applied to by the client. On their investment accounts, these clients desire to use a 7% average earning rates on IRAs and Roth IRAs and a slightly lower 6% rate on taxable investment accounts. It's not unusual to use a slightly lower rate on taxable accounts because these accounts tend to be invested more conservatively. To help offset their budgetary needs at the age of 70, John is expecting $39,000 a year of Social Security income using a 2.5% inflationary increase on that number. However, based on our recommendation, he was able to file a spousal benefit beginning in August 2019, and collect $1,248 a month. He'll still get deferral credits on his own benefit until the age of 70. Because he was born before January 1954, that allows him this special treatment. His wife, in the meantime, will also be collecting her benefit of $28,840 a year, beginning in the same month, August of 2019. By the way, this portion of the Social Security planning, it's part of our services as we integrate Social Security into the tax plan. Over the next 20 years, our recommended strategies would save John and Linda just shy of $70,000 in income taxes. While the $70,000 is saved over 20 years in this plan, more of the taxes are indeed actually being paid up front in our proposition. So in fairness, we should indeed question how this upfront payment of taxes would impact their wealth on a long-term basis. Beyond how much taxes are paid, a greater emphasis in our plan is placed on the wealth analysis. But to us, just as important as reviewing gross wealth, we believe it's also important, if not more so, to analyze the net wealth. By net wealth, we're referencing not just the amount in the IRA accounts that you get to see on your statement, but the amount of money that's truly yours and your family gets to keep and utilize after paying off the mortgage to the IRS on those accounts. To analyze that, we have to assume that a certain portion of your IRAs and other qualified accounts will be lost funds to income taxes, either by you at some point or ultimately by your heirs. Based on the assumptions used, at the end of 20 years, if John and Linda followed our proposed strategies, their gross wealth would actually decline by approximately $42,000. But if we assume a 25% mortgage on the IRA assets, their net wealth would have increased by approximately $200,000. There's probably a better way of evaluation to look at this benefit. On the gross wealth side, before considering any built-in liability or mortgage, the question that I'd pose to you is, would you sacrifice $950,000 of IRA assets, which would be subject to the tax on distribution, subject to required minimum distributions, and would you also sacrifice another $750,000 in your taxable accounts, where the growth that you earn is taxed each and every year, if we were able to replace that with $1,650,000 in a Roth account, never to be taxed during your lifetime, nor the lifetime of your heirs, again? If you feel that that question needs additional consideration or thought, please pause the video right here and give it some thought, or rewind it a little bit and listen to it once more. Here's a second way to evaluate the trade-offs that are presented. The top 5 rows in this graph reflect data on a gross basis, and the bottom 5 rows on a net basis, which is assuming a 25% mortgage or liability on the IRA. If we compare the current column versus the proposed column, and the proposed plan, we would have sacrificed $751,000 in the taxable account, and we would also have given up $957,000 in the IRA on a gross basis for a combined sacrifice in those two accounts of just over $1.7 million in wealth. However, in the proposed plan, we would have gained $1,666,000 and change in the Roth IRA. That effectively means we were able to transfer 97.5% of our gross wealth from the IRA and the taxable account into the Roth IRA. Translated, that means our cost of the transfer, net of all taxes paid, was 2.5% after 20 years' time. If I were to suggest that you could realign your wealth into a Roth IRA, and after 20 years the cost for this realignment was only 2.5%, would that be attractive to you? If you understand the value of the Roth, If you've watched my dollar double presentation, the extended one, you understand that this question is rhetorical. If we did the same review and we look at it on a net basis, meaning that we assume that you own 75% of your IRA and Uncle Sam owns 25% of your IRA. So we're only looking at your 75% that you own. The 25% that you don't own is the mortgage portion of your IRA or the tax liability that's embedded in your account. If we use that assumption in net wealth terms, the portion of the IRA that truly belongs to you, you really only sacrifice $670,000 of your portion of IRA assets, in addition to the $750,000 of taxable assets. Meaning on a net basis, those two reductions are $1,420,000. But in exchange, if you had $1,666,000 in your Roth IRA, the Roth IRA would represent 117% of the value decline of the other two accounts. So in essence, the government paid you 17% to prepay your mortgage. I could ask the question if that would be attractive to you. For this couple, we did not recommend a Roth conversion of 100% of the IRA. At the end of the 20 years, we would still have a value in the IRA of about $176,000. That's because for this couple at the end of the 20 years, they could still take required minimum distributions on the $176,000 and be in a zero tax bracket. After our initial strategies are implemented, this couple would pay zero federal taxes, and depending on their state of residence, zero state taxes as well. So for this couple, let's look at the evaluation for their heirs. Since the heirs under present law can stretch IRAs and Roth IRAs over their lifetime, that means that there's a continued tax benefit while distributions are allowed to be deferred on a continued basis. If we wanted to analyze the value of the two scenarios, current versus proposed for heirs, we need to make certain assumptions. In this case, based on their kids' ages, we assume the distribution period for the heirs is 36 years. In order to compare the two options, we want to assume that the heirs only take distributions that are required, and they reinvest them in a taxable account to be left behind for a third generation. The residual value to the third generation, after growth and taxation of column A, over a 36-year distribution period is $14 million in the current plan. And in the proposed plan, column B, the value over that same 36-year distribution period is $28 million, which represents a 100% increase in wealth for the heirs. In case study number 2, we changed our client names to Eric and Jane. In this particular example, we are able to propose a tax savings of over $1 million and increase their net wealth at 20 years by over $3 million. Eric is a retired engineer, and his wife spent most of her life as a homemaker. They've accumulated a fair amount of assets, which are displayed on the screen. Eric is age 66, and Jane is age 61. And they've been our clients since early 2008, before the crash occurred. At that time, their total investments were about $2 million, and they've done quite well between then and now. Even though he came in with just $2 million before the crash, they have over $5.4 million at this time with us. Eric gets a pension of $112,000 a year, which is not inflation adjusted. Jane started receiving Social Security at age 62 in March of 2019, just shy of $11,000 a year. Eric started a spousal restricted benefit when he turned 66 in April of 2019. It's a small benefit of $605 a month. When we use a 2.5% inflation rate on the Social Security with deferral credits, by the time he's age 70 in 2023, his Social Security is expected to be nearly $41,000. Their earnings forecast that they chose to use is 8% on IRAs and 6% on taxable. That 8% tends to be a little assertive for us, but since we've earned double digits for this client since he came on board, we're okay using those numbers. And at the end of the day, it's the client's choice what earnings rate we use anyhow. They feel comfortable using a 3.5% inflation rate on lifestyle and 6.5% inflation rate on medical. The lifestyle need is $125,000, which is all inclusive of everything except for healthcare. That's listed at $15,000 until the spouse turns age 65 and then reduces down to $12,500 when they're both on Medicare at that time. For them, the 20-year expected income taxes on the current plan was over $3 million. And using our proposed plan, we were estimated to be able to get that down to $1.9 million, a savings of over $1 million in taxes. We have a pretty assertive tax plan in place in order to do that. And for the record, there was 4 differing tax scenarios that we looked at for this couple. This proposed plan being the one that they opted to do. At the end of the 20 years again, we're not completely eliminating the IRAs, but we're reducing them substantially by over $6 million. And at the end of 20 years, we are proposing to be able to increase gross wealth by over $1 million and net wealth by over $3 million. We anticipate having almost $13 million in the Roth IRAs by sacrificing the IRA assets of $6 million and reducing the taxable account by $5.5 million. At the end of the 20-year proposed plan, gross wealth is expected to increase again by $1.3 million and net wealth by over $3 million, which is a more than 20% increase in net wealth. So here's the measuring sticks that we like to use. After 20 years of expected sacrificed wealth in the taxable account is $5.5 million, and the sacrificed wealth in the IRA is $6 million. So the total sacrificed in those 2 less tax-efficient accounts on a gross basis is $11.6 million. But the expected outcome is a gain in the Roth account by almost $13 million. That means that the gain in the Roth is 11.5% more on a gross basis than the sacrificed assets in those 2 less tax-efficient accounts. So a rhetorical question that I'd like to ask is, would you reposition your assets if you knew the IRS would pay you 11.5% to do so? That means you'd be getting paid 11.5% to prepay the mortgage in your IRA account. If we do the same analysis on a net basis, meaning in this couple's case using the assumption that 68% of the IRA belongs to them and 32% belongs to the IRS, that's because they're in a higher tax bracket, as are their children. Therefore, with this assumption, the sacrificed value of the IRA portion that belonged to the client was only $4 million rather than the $6 million. That means the gain in the Roth IRA would represent a 33.9% over and above the sacrificed wealth of the net wealth in the IRA and the wealth in the taxable account. So would you do that if that was proposed to you? And then if you were the heirs, would you rather inherit what's reflected here as column A, or would you rather inherit column B? If you were the heirs and you were able to stretch these accounts and accumulate them over a 45-year distribution period, here's the expected value on the screen of the stretch for the heirs. If we move on to case study number 3, that's Michael, and we're able to show a $1 million value gain for his family. Michael is recently widowed. He's a window installer, a self-employed blue-collar worker. He had $440,000 in his IRA. He has $105,000 in his Roth account already because of conversions that we suggested. And he has $616,000 in his taxable account. At 63 years old, he recently sold his business and he receives a very small pension from the union of $8,500 a year. As a widower, he's receiving a Social Security check of $9,600 a year, and when he reaches the age of 70, his projected Social Security, using that very common 2.5% Social Security inflationary increase rate, that'll be $51,000. His expected earnings assumption are 6% on taxable, 8.5% on IRAs. The lifestyle that this client says he needs is $41,500 a year, with health care starting at $13,500, using a 6.5% inflation rate there, but that going down at the age of 65 when he reaches Medicare. He's got some long-term care insurance, and he's not expecting any inflationary increase, although you never know for sure with long-term care insurance. And then his autos, he desires $50,000 a year at the next time he makes a purchase of 2023 in today's dollars, applying a 3.75% inflation rate to that. He wants to use a little higher inflation rate than most others, but again, that's perfectly fine. These are the line items that we have for him, and they're selected by him. Inside the plan, travel, which is usually an excluded separate item, it's included in his lifestyle in this particular plan. So over 20 years, we expect a $52,000 tax reduction for Michael. About 15%, which isn't so bad. But the real gain for Michael is on the wealth side. Over 20 years, on a proposed basis, we would completely eliminate Michael's IRAs. His sacrificed wealth in IRAs over the 20 years is $1.2 million, as that's the proposed value that would be in his IRAs if he didn't do any more planning. And his taxable accounts, the sacrificed wealth, is $525,000. But his gain in the Roth IRAs is a remarkable $2.5 million. So on a gross basis, he's gaining $744,000, or roughly 25% in gains on his gross wealth over and above what he's given up. Continuing on, he would gain 40% on a net wealth basis, which is a remarkable feat. His plan becomes a no-brainer in this regard. It's a huge difference for him, and it's a huge difference for his heirs. So as a single filer, it was rather significant to be able to do these kind of things and have this particular outcome. In this case, we did have to do some additional strategic planning beyond just Roth conversions in order to reduce the tax burden. So it's not always just about Roth conversions. And the real trick with the Roth conversions isn't, should I do it? It's how much, how frequently, when and how. Those are really the trick questions. Because there's a big difference between converting $100,000 a year and converting $300,000 a year. It matters at the end of the day. There's other strategies, though, in addition to the Roth conversions that we employ that are providing a benefit, and they're providing those benefits in Michael's case. They were certainly needed. When our 20-year plan for Michael is complete, there's a lost value in the taxable account or sacrificed value of $523,000 and a sacrificed value in the IRAs of $1.2 million. But the gain on the Roth is a whopping 42.5% more than the wealth giving up in these less tax-efficient accounts, almost $2.5 million. To have a 42% gain in the Roth over and above the lost value in the taxable account, that's a golden goose, and I don't promise that for everybody. But a tax-free Roth account provides complete financial freedom, which is why we call it the Advanced Financial Freedom Plan. You need to understand that you can take as much out of the Roth anytime you want to without any concern of taxation. You can purchase $1 million chalet in France and not pay any taxes on the Roth distribution to buy it. Or you can buy a condo in Vegas or a Lamborghini out of the account and have zero tax consequences. Can you imagine having to take $150,000 out of your IRA because you wanted to buy a condo as a second home, and then having a $60,000 or $70,000 tax bill next April, effectively increasing the cost of what it is you wanted to buy by 40%? Versus if it's in the Roth account and you take the money out tax-free. Or imagine if your child or grandchild got in trouble and you needed to take $50,000, $75,000, or $100,000 out of your IRA, and then have the tax bill that came with that the next year to help your child out. Versus it being a Roth IRA, and you just take it out of the Roth. You have the financial freedom to do that without worry of taxation. If you want to help your grandchild with college expenses, you get the point. Again, that's exactly why we call it the Advanced Financial Freedom Plan, using advanced tax strategies to gain financial freedom for you. For in Michael's case, if you had a balance sheet that looked like column A or a balance sheet that looked like column B, that's the freedom that this planning brings to folks. And that's why we love to do it. So when thinking about these plans, think of them as a gift. Consider them freedom. Please schedule a call with the tax planners now and let us discover ways to maximize your net wealth through our strategic tax planning. With our money-back guarantee, what do you have to lose? Start your Advanced Financial Freedom Plan with us today. I'll close this presentation with a few myths. Myth number 1, taxes do not have a dramatic impact on your wealth. Well, I could assure you and demonstrate to you that they do. Myth number 2, There is nothing I can do about income taxes. That's a complete myth. Absolutely, positively, there is something you can do about income taxes. Myth number 3, I'll be in a lower tax bracket in retirement. That is a myth for most of the people that we meet. Not most of those people are in a lower tax bracket. Some of them are in a higher tax bracket because of the double taxation that I talked about earlier. And myth number 4, save in your 401k. Well, actually, I want to encourage you to teach your children that might want to save in their 401k. But they want to have an advanced financial freedom plan when they start hitting their mid to late 50s, so that when they get to retirement, they can learn how to turn the table on the IRS before it's too late. So please give us a call and let us help you discover ways that we can help you with your planning, more specifically your tax planning, today. Thank you.